Hi, this is Barry Haimo. Thanks for tuning in for another dose of bite-sized bits of knowledge where we give you meaningful information in a short amount of time. We just finished up the corporations video, and today we're going to talk about S corporations. So S corporations are legally a corporation. At the state level, the state doesn't care what you are. You're a corporation. You're an Inc. You're a corp. You're a corporation designation at the end of your company name. S corps, however, have an election to be treated differently from a C corp and to be treated as an S corporation. It's an affirmative election. You have to make it with the IRS. The IRS is the only entity that cares about whether you're a corporation or not. Okay? And that's done on a special form, and it needs to be done on time. So S corporations are important because they put restrictions on corporations that don't otherwise exist. So to keep that tax designation, some of the restrictions are as follows. First, you're limited in number and type of shareholders. Specifically, you're limited to 100 shareholders, and all those shareholders must be U.S. citizens, and they look through the shareholders to see who the shareholders are in terms of what's called related parties, to make sure that you're not saying there's 100 shareholders, but there's really 1,000, okay? You're also limited in the types of classes of stock that you can have, whereas a C Corp can have multiple classes with preferred and common and class 1, class 2, class 3. In an S corporation, you're limited to non-voting and voting of one class of stock. So you're very limited there. In terms of taxation, it's very different. In a corporation, you have your 1120S, and it's taxed at the entity level, and then dividends or distributions are taxed again at the shareholder level, thus making it double taxation. In a S corporation, the S corporation files an 1120S with the IRS that just reflects the profits and losses, the shareholders and each of their percentage interests in those profits and losses, and then the shareholders report their share on their 1040s. So they get a K1, they give their K1 to their accountant or CPA, and the CPA prepares their returns, including those profits and losses on their personal returns. So you could theoretically have 5 partners where one's a doctor, one's a teacher, and they all make different incomes, and they're all going to pay different amounts of tax on the same amount of percentage interest, because each one is paying their own tax based on their own personal income. So it could be a lot lower taxes as a result than the C Corp. I would say the only limitation on transfers of interest that a C Corp doesn't have would be, you just got to be mindful that if you violate your S corporation restrictions, you're going to lose your status as an S Corp. And that's bad because that could be a taxable event. That can cause you to basically have to pay a lot of taxes. So you really want to be careful about that. I would wrap up by saying that S Corps are great for small businesses that are service businesses, and they want to stay small. If you're looking to get bigger, scale, grow, go public, you cannot be an S Corp. I'd highly recommend that. And also make sure your CPA doesn't knee-jerk you into an S Corp prematurely without getting your holistic counsel, like we've told you. So I hope you found this helpful. Don't forget to download our free Florida business entity chart and our free business planning stress test. The links are in the description. Thanks again for stopping by, and stay tuned for more.
Haimo, Haimo.